Everyone knows the yield curve flashed red before 2008, but what fewer people remember is that it warned of nearly every major downturn before that. So what if today's signal is deeper, sharper, and longer than any we've ever seen? Well, if history rhymes, the next chapter isn't a soft landing, it's a reckoning.
Look, this isn't just some dramatic overstatement. For almost a century now, this peculiar behavior in the bond market has served as a kind of final warning before the storm. It flashed red right before the dot-com bust, and of course, before the 2008 financial crisis. And right now, it's not just flashing, it is screaming. Stay with me on this, because by the end, you'll see exactly why the math leaves us with a lot less room to breathe this time around.
Okay, so to really get the gravity of the situation, we first have to understand the signal itself. What the curve actually measures, why its inversion seems to come right before recessions, and how these past warnings were basically like ticking time bombs.
So, in simple terms, the yield curve just compares short-term treasury yields to long-term ones. And normally, lending your money for a longer time pays you more. It's pretty logical, right? It's a fundamental barometer of economic health, really just a snapshot of the market's trust in the future.
In a healthy, growing economy, that curve slopes upwards. Makes perfect sense. But when it inverts, when you get paid more for short-term debt than for long-term, the market basically starts whispering. Growth is going to slow. The Fed will have to cut rates later. Buckle up. It's not magic, it's all about expectations. The sequence is almost always the same. Tightening, then a slowdown, then cuts. And that sequence is exactly why these inversions pop up right before recessions.
And believe me, this isn't just some theory. I mean, look at the track record. 1989, 2000, 2006, each and every inversion was a prelude to a recession. The signal's predictive power is, well, it's almost perfect. Back in 2006, as the curve inverted, the main story you heard was, oh, there's a global savings glut, housing is solid, the curve is broken as a predictor. Sound familiar? Yeah, 18 months later. Bear Stearns collapsed, then Lehman Brothers.
You see, the curve didn't cause the 2008 crisis. It just time-stamped the turn in a credit cycle that everyone assumed couldn't end. Which of course brings us to today. The signal is back, but this time it feels different. It's not just an inversion. It's a historic anomaly that has economists everywhere scrambling and rewriting their models. This isn't some brief flicker of fear we're talking about. The yield curve has now been inverted for well over 20 months. I mean, that is the longest, most persistent warning sign we've seen in modern financial history. This kind of sustained stress, it really reshapes behavior. Banks start to tighten lending, businesses reprice risk, and long-term spending just stalls out.
And it's not just about the duration, it's also the depth. Just like the quote says, the deeper that inversion goes, the worse the crash that tends to follow. And historically, this holds up. Shallow inversions have led to mild slowdowns, but deep inversions, like the one we've been in, they've preceded some really devastating economic crashes. The signal isn't just on, it feels like it's been turned up to maximum volume.
So, if this is the most severe and longest-lasting warning signal we've ever seen, where's the recession? I mean, the economy, while, yeah, it's showing some cracks, has stayed surprisingly resilient. And this is the central puzzle we really need to solve, the profitability puzzle.
Why has this legendary predictor seemingly failed to deliver on its promise of economic pain? Is the indicator finally broken? Or is the fuse on this particular time bomb just much, much longer? To answer that, we really need to look at the mechanics of how inversions used to cause recessions.
Traditionally, the yield curve didn't just predict a recession, it actually helped cause it. As you can see here, it's basically a four-step process. The curve inverts, bank profits get squeezed, credit tightens up, and then the economy just slows to a halt. This is the transmission mechanism. This is how it's supposed to work.
But look at this. Just notice the stark contrast here. We've got negative bank credit growth during the 2008 crisis and positive growth today. This is what's different. Unlike in past crises, the lifeblood of the economy, credit, it's still flowing. So why?
Well, the reason is actually pretty fascinating. Even as the Federal Reserve was aggressively hiking short-term rates, the rates that banks pay you and me on most savings deposits, they barely budged. Thanks to this glut of cash that's been sloshing around the system since the pandemic, banks just didn't have to compete for deposits. Their funding costs stayed at rock bottom, so their lending has remained profitable. The traditional recession-triggering mechanism seems to be jammed.
But a broken banking channel is really only half the story. There's another, more technical argument that the signal itself might not be what it appears to be. The data could be distorted. Which brings us to our next big question. Is the data distorted?
So we can break the nominal yield curve down into two key parts. There's the real rate slope, which reflects expectations for pure economic growth, and then there's the inflation compensation slope, which is really just the market's forecast for inflation down the road.
Now here's the key insight, and this is based on research from the European Central Bank. Historically, it's been the inflation curve that's been the better predictor of a recession, but today, today the real curve is the one driving the inversion. This might suggest the signal is reflecting a totally different set of economic conditions than in past downturns.
And there's one more potential distortion to consider. Years and years of quantitative easing may have artificially pushed down long-term yields, which would contribute to the inversion. The signal itself may be fundamentally distorted by past central bank policies. In other words, the very ruler we're using to measure the economy could be warped.
So, where does that leave us? Is this whole thing signal, or is it just noise? We have a legendary indicator flashing its most extreme warning in history, but at the very same time, we have some really compelling reasons to believe its core mechanisms might be broken, or that the data itself is just plain distorted.
Let's just weigh the evidence here. In the column for the signal, we have historical precedent. I mean, you can't argue with that track record, and the unprecedented severity of the current inversion. But then in the column for the noise, we have a jammed bank lending mechanism, an inversion being driven by a less predictive component, and potential data distortions from years of central bank actions.
So we're left with a fascinating and, frankly, a critical question. Is this the signal that finally cried wolf? Or is this the deepest, quietest silence right before the storm? The bond market? Well, it has made its bet. The real economy has yet to fully respond. And that next chapter? It might not be a soft landing. It might just be the reckoning this signal has been warning us about all along.